So they they picked me for a little comic, relief here late in the afternoon on Friday, the gold guy. But hopefully we can keep everybody awake. That's me. So I've been giving speeches and meeting with trustees, et cetera, about gold really since 2001. So it's about 18 years. And I've learned three things over that time period. Number one, in the 18 years, thousands of meetings, I've never once convinced anyone to buy gold just because they spoke to me. Number two, there's no asset that really has more investment cues than gold. Some people think it's an inflation hedge. Some people think it's a deflation hedge. Some people, look at it as risk on, some risk off. And when there's stress in the marketplace, some people, very small percentage, would think gold would be a good safe harbor. But it's a smaller number than it used to be, but still most people would look at the dollar as the safe harbor, and obviously that has negative implications for gold. So the other thing I've learned, the third thing is most people have a fairly strong opinion about gold, whether or not they have any command of sort of underlying fundamentals, or realities. It's just sort of a personal, emotional feeling. And so I've learned, don't try to talk anyone out of their gold views or their gold target or whatever. It's probably a waste of time. But what I thought I would do today is just to give, not to convince anyone of anything, but the way we look at gold, just to give an overarching, sort of perspective on how to look at the gold trade and what we're really up against or retaining for our portfolio when we own it. So this is a pretty simple chart. It's the first rule of public presentations, never put a bunch of numbers on a screen. But the reason we've done this is the 19 past years of gold's performance in the 9 fiat currencies that sort of rule the globe. And the whole point of this is there's not a lot of red on there. So here we are in the 19th year of gold's bull market. Admittedly, we started, right when gold started to take off. But it's the best performing asset in the world in all these different currencies through all these different periods. We've had periods of mostly falling rates, long and short, but we did have, for example, 2004 to 2006, when the Greenspan Fed, if you can recall, raised Fed funds at 17 straight meetings. And we went from 1 to 5.25 in a 2-year period, and gold during that time frame was up a peak of 83%. So we've had round trips in, commodity markets. We've had round trips in equity markets over this time period, but gold still puts forth these remarkably consistent annual performances. So our point there is there must be something going on here that unifies all of these different people's decisions about gold, other than the knee-jerk reactions that we read about in the press all the time, such as geopolitical concerns, et cetera, et cetera. And the one chart that I think brings this all together, if you were to say to me, put the gold story in one chart, this is it. And to us, this is the only thing that really matters. All these geopolitical turmoils, especially in the last 3-4 weeks, we've got Brexit ramping up again. We've got trade wars every day. We've got now Syria. We've got Turkey. We've got Russia. All of that is a distraction to what the underlying fundamentals are of the gold trade. And to be honest with you, whenever we have a distraction like that, I get sort of distraught because it brings in a whole group of people that then have to get out. So it just sort of delays the underlying factors driving the gold price, and those are all monetary. So this is debt to GDP in the United States for the past 100 years. And it's always between 140 and 170%, except for during 2 really black swan events. The first was the Depression, and the second was Alan Greenspan and Janet Yellen and Bernanke, et cetera. And in the first example, we had GDP fall by 45%, the debt remained constant, and we got to 287% on the debt to GDP ratio, and FDR had to outlaw private ownership of gold for what turned out to be about 40 years and debase the dollar 40% against the gold price. In the current example, we have more of a numerator event as opposed to a denominator event, and we've been piling up tens and tens of trillions of non-productive credit atop a relatively stable GDP over, say, the last 15, 20 years. Our view is that that debt to GDP ratio is why everything feels so bad all the time these days. And because debt is a structural issue, most professional money managers have long since given up trying to figure out when it's going to be resolved or how it's going to be resolved, because it's impossible to predict. So, you know, most portfolio managers and their star strategists don't spend a lot of time trying to figure out how this structural debt problem will be solved. I do think that's why gold has had this very consistent performance, though, because at the margin, in this massive pile of financial assets that's out there, each year maybe 0.5% of people decide to seek, harbor in gold and other things that can't be printed, like fine art and Honus Wagner baseball cards and fine wine and all that kind of stuff. But the point of this is we haven't accomplished anything since the financial crisis in bringing these debt levels back more into alignment with underlying productive output. So this is why we had QE1 and QE2 and QE3. It wasn't, in my opinion, related to employment levels. It's the Federal Reserve Bank, not the Federal Reserve Bureau of Unemployment. That's their, public defense for what they do. But it's all about stress in the banking system. And to resolve this imbalance, there are only two solutions, and they're default or debasement. So we're either going to default on all this non-productive debt, or we're going to debase it, and central banks will do everything in their power to choose debasement over default. So the two current iterations that I would talk about that are very interesting to me are negative interest rates and then this repo kerfuffle, which has been going on now for about a month. So this is the history of interest rates all the way back to 3000 BC. So back to Mesopotamia and 3000 BC and, the other historic societies along the way, interest rates were always around 20%. That goes back to 3000 BC. And then you get up to the Roman Empire, and 300 years of relative stability of the Roman Empire got long-term rates down to about 4%. Then after that, they've sort of oscillated in the high single digits for really in the AD environment. We've had two brushes with the zero bound, and they were the Depression and World War II. But even in those black swan events, the Fed never felt compelled to visit the area of negative policy rates. So even with the Depression, World War II, 5,000 years of history, we've never had negative interest rates. And the reason is they're absurd. The problem with that is they do exist, and as recently as a month ago, to the tune of 17 trillion in the sovereign category, which to us is mind-boggling. So how did we get to a position where after 5,000 years, we suddenly have $17 trillion worth of negative yielding paper? Well, this is 100% the fault of central banks. After the great financial crisis, whatever you want to call it, central banks' hubris level reached new heights, and instead of letting all this debt clear and having a recession and rationalizing all of these outgrown obligations on underlying output, central bankers, first in the Eurozone, started experimenting with negative deposit rates. The reason they originally did it, Switzerland and Denmark were trying to calm their currencies down because they were appreciating too much and they wanted to defend various pegs. So in the 2014-15 area, a couple of the European central banks started experimenting with negative deposit rates. To sum this whole period up, I picked this one quote. It's one of my favorite in my entire career. It's from a guy named Vitas Vasiliauskas, who's the Lithuanian central bank governor, his least important title, but more importantly, is on the ECB governing council member. And he's still on there, by the way. And Vitas said in May of 2016, think back to that time, gold was going ballistic. Remember, from January to August of 2016, gold was up 42%. GDXJ was up almost 200%. But this is what he said. Markets say the ECB is done, their box is empty, but we are magic people. That is a real quote. That's exactly what he said. We are magic people. Each time we take something and give it to the markets, a rabbit out of the hat. Okay? So he's on the ECB Governing Council, and this is what we got from them. We now have, it peaked at 17 trillion, but it's a little under 14 trillion now in negative yielding bonds. Now you might say, why are you talking about this? Look at the correlation to the gold price. So, you know, again, I'm not saying geopolitical stuff is not linked to the gold price or that certain people don't want to link it, but this is what drives the gold price. Recognition that this debt situation, which is the Minsky moment that everybody's ignored for maybe 10, 15 years, may finally, you know, be hitting the ground in terms of its impact on asset prices. And in that type of environment, remember we said earlier the only two outcomes are default or debasement, and I don't want to get you know, preachy here, but gold becomes a mandatory portfolio investment in this type of an environment. You know, a little bit of a gold exposure can really help when we start to get these, I call it a recalibration of enthusiasm for U.S. financial assets. Now, I've learned that because you can never say to anybody, stocks will ever go down. That'll clear out a conference room faster than you can imagine. But if we ever have a recalibration of enthusiasm, you know, gold is something that you need to have. So this brings us to the Fed and the United States. I personally don't think negative interest rates will ever be employed in Fed fund policy decisions by the Fed because of fractional reserve banking and pension funds and insurance companies and money markets. It just, capitalism doesn't work with negative rates. We've had this 2-year experience in Europe or experiment 3-year, and I think the returns have been pretty marginal. And I don't think that the Europeans or the Japanese have justified in any way that the ends have justified the means. So we have the Fed, and just, I'm not a tinfoil guy, but there's 2 problems with the current Fed. They didn't recognize that the dual agenda of balance sheet reduction and rate hikes was far too aggressive in the environment of the current debt outstanding. Number 2, and perhaps more important, I think that over the last 12 months, it's become very clear that this particular FOMC group of folks has no idea how to roll back 7 years of ZIRP and QE, and they're really just, you know, sort of playing it by ear. The best example of that is Chairman Powell in December was very clear when he said that balance sheet runoff was working well on autopilot and not subject to review. About 2 weeks later, he seemed to be reading a prepared speech when he said he was open to ideas in reversing the autopilot nature of the Fed's balance sheet reduction if events made that necessary. By March 20th, 3 months later, they had announced the end of the entire program. It was going to be wound down in September, but it was too risky to wait for September to wind it all down, so they were going to stop buying MBS right away and cut the $50 billion in treasuries they were purchasing to 25. So we went from December to March, in 9 months, 90 days, a complete reversal. And this isn't like, you know, planning a summer vacation or something. This is a frickin' $4 trillion balance sheet, and clearly the Fed has no conception of the impact of that balance sheet on global monetary affairs and money supply. So in the current kerfuffle, the repo rate goes to 8.5 overnight, 24-hour period, and everybody goes, well, it's archaic technical plumbing. It has to do with reserve assets, not really that big a deal. Well, 8.5%, and there are some snapshots that were up to 10, but I've been able to verify that it got to 850. So 850 up from the prevailing overnight general collateral repo rate, which has been within 0.26% of the Fed funds rate on average since 2006. So 0.26. So whenever the repo rate goes like 10 basis points above Fed funds, you got $1 trillion willing to plug that hole. And in one night, we went from 226 to 850. That's 44 standard deviations. 44 standard deviations in a $2.6 trillion market, which has been, because of the risk-free nature of the loans, it's collateralized by treasuries, anybody would, step into in a moment's notice. So now everybody's speculating why that happened. Is it, Jamie Dimon being cute, getting the Fed back for all the regulatory? We really don't know. But 44 standard deviations on a $2.6 trillion market is really a sign that there's something else going on. So now the debate has moved to, first of all, the other thing that we've learned about the Fed, they were completely out of touch with the needs of their primary dealer network. So at the very least, we can admit that, right? They didn't see this coming. Then they reacted with a one-day 75, then it was every day for a couple of weeks, then it was every day through next year, and now we have the $60 billion in Treasury bills we're going to buy every month, and they already started. The first $7.5 billion was 2 days ago. It was 4 times oversubscribed, and we're going to do that through the end of Q2 of next year. So that's about $600 billion. So we took the balance sheet up at the Fed from the 850, 9.25, whatever you want to start, to 4.5 trillion. We were going to take it back to 2-ish or 1. We got to 3.7. They realized the pot was overflowing, the kettle of demand for reserves. We've stopped it, and now in 4 weeks, we've already reversed a fourth of it. And we have all these different, comments. Well, it's not really QE because we're not affecting commercial, bank asset or liabilities, and we're focused on very short-term measures. But this isn't about. I don't give a shit what you call it. I mean, it's obvious there's a problem. So okay, don't call it QE. Call it whatever you want. But we just undid 25% of that, on autopilot balance because the system needs enormous liquidity because of all of these bad assets and excessive debt. So this is just a throwaway slide too. Gold, in terms of its performance and what drives it, this is the 12-month trailing budget deficit. It's not really on the front page again, but it's coming. It's really becoming a problem. This is a very tight correlation. And if you just get to like 1.1 trillion, that implies on the gold price, another 350 points. So I think that's, in our future in the next 6 months. I threw these in just sort of for fun. I've always gotten a kick out of the fact that gold has so little institutional sponsorship. And so just very briefly, these are 7 of the most sophisticated hedge fund indices, which we could track. We work with the World Gold Council. The blue bars on the top are the performance of those most sophisticated Ferrari hedge fund, private equity, venture capital indices of funds. And for 18 years, from 2000 to 2018, the orange lines were 2018, the year. The first item is gold. So my only point is, gold kind of holds its own in the middle of that 18-year performance of the most sophisticated funds in the world with no fees and no lockups. It's just interesting that institutions fight it so much. And then this is the correlation to the S&P. So it's the same 7 super sophisticated Ferrari hedge fund indices, and the gold bar is their correlation to the S&P. So it ranges between 81 and 71. The blue bar, we obviously didn't do a good job on the slide, is the gold correlation, and it's close to 0. So for no fees, no lockups, it seems to me it would make sense for a few institutions to start taking some gold exposure. With respect to the equities, everybody's seen this chart. This is the XAU to gold ratio, and for 30 years it was always 0.25, and then we had the 2008 experience, and there are some reasons this ratio should be a little lower today. There's more shares. There have been a lot of mistakes made. Projects are tougher. But anything that falls 75% in relative valuation, especially with the the underlying product or output being gold, which is pretty homogeneous. This is a Jeremy Grantham, reversion to the mean opportunity. A lot of circles here. Gold stocks and the S&P have been negatively correlated twice in the past sort of 30 years. The first was heading into March of 2000. That first inverse correlation was the internet bubble, and nobody wanted a gold stock. Let's just put it that way. Nobody wanted Smucker or Progressive or anything that was difficult, and so gold stocks were thrown out. When the S&P fell 52% from March 2000 on, gold stocks tripled. And then in the middle, with all the sort of central bank mishmash, they actually started to demonstrate a positive correlation, gold stocks and regular stocks, not gold and regular stocks, or gold and gold stocks. This is gold stocks to the S&P. And everybody remembers 2008, which is why people think that if the market crashes, gold stocks are likely to go down, because everybody remembers the last event, which was 2008. But since September of 2012, which was literally the announcement of open-ended QE, I will go to my grave never really understanding. I told my wife that night, we can buy the Mercedes, we're done. QE open-ended. Gold went down every day for about a year and a half. Gold stocks collapsed, and every tick since then has been up for the S&P. What about unlimited QE is so good for stocks and so bad for gold stocks? I don't really get it. But assuming that no foul, I don't want to be a conspiracy guy, but assuming this happened naturally, it was really starting to reverse right before Trump got elected. We call this slide in our office the jaws of life. So you can see some like fangs forming in that first green circle, and that circled boost in the GDX was 2016. You remember that? So from January 1 to August 11th, GDX was up 125%. I was depressed again. My wife was like, what's wrong? They're going up. Isn't that good for us? I go, no, they're going up too fast. We haven't raised any money. No one's investing. So she says, well, let's see. Let's get this. Gold stocks go down. That's bad for us. Gold stocks go up. That's bad for us. Is there anything about this trade that will ever be good for us? But we're starting to see that jumpiness over there, and you can have your own view about stocks, but I can't even explain it. We had the internet bubble, this bubble. What would we call this? So if I were the state of Minnesota or city of Houston, 5% from your S&P allocation, even to the GDX, seems to be an absolute no-brainer. And then this is my last sort of messing with the gods. So I have a view that gold stocks perform the best when, remember I said earlier, faith in U.S. financial assets is being recalibrated. That's code for stocks go down, but you can't say it that specifically. So when people start to question reigning valuations of U.S. financial assets, gold stocks, believe it or not, go ballistic. And so since 2000, there's been by coincidence, 3-year, almost to the day, expansions in the GDX. And they were 2000, 2007, and 2008 to 11. And the movements were up 342, 185, and 309. During those same periods, the S&P was down 22, up 10, and up 38. Now, I understand no human being or computer or Zeus could ever time this from beginning to end, so this next fact that I'm going to give you is completely irrelevant. However, the fact remains that if you compound those advances, you get 5,081%. And if you compound the performance of the S&P to the day, you get 20%. So that means for 9 of the past 19 years, or a little under half the time, gold stocks have outperformed the S&P by a factor of 249 to 1. So this isn't 9 weeks or 9 months. This is 9 years. Of course, the problem is timing it. And again, you see this small little mountain to the right of the big mountains. We were really on the way there in 2016. Timing is obviously, the most important criteria, and I think it has to be taken into account. It's like a joined responsibility between client and manager. But when it's time, there's a period out there if faith in U.S. financial assets is finally starting to be recalibrated, where we're going to have, you know, a 200-300% move in gold stocks. And I just think it's important to keep that potential in mind as a portfolio quiver. So that's what I had. Any questions? Sure.
I still don't understand what happened in the repo market. Why there was a sudden shortage of capital.
Right. So there are a lot of theories, and just this week, because of J.P. Morgan's conference call, the J.P. Morgan example or explanation is getting the most weight. And what happened is, I think J.P. Morgan's balance sheet is like 2.3 trillion or 2.7 trillion. And because of the regulatory requirements, they usually keep 500 billion in a checking account at the Fed, and they're the loaner of last resort. So when you get quarter end or month end, everybody just goes to J.P. Morgan and they lend the money out. In this particular example, I guess it was about 150 billion was what was needed in the market, and J.P. Morgan would normally move their reserves to the repo market because it's slightly higher, maybe 10 basis points, but they felt they couldn't because of the regulatory stuff. So I'm pretty cynical about that because, you know, in a $2.6 trillion market, you just can't convince me that somewhere between 2.25 and 8.5, there wasn't a few, you know, 100 billion lying around that somebody would be happy to take that increased yield. Keep in mind, it's on a fully collateralized, riskless security, right? They're getting treasuries. But that's what the market, that's the conclusion that is coming to the top of the heap. The other, like I was thinking, maybe it's WeWork. You know, WeWork has 50 billion in lease obligations. They're obviously bankrupt. I read a story today that SoftBank's going to take them over at 8 billion or finance them at an $8 billion rate. It was just worth 47. So everyone's going to take, you know, it seemed to me there's something a little bit more enticing than, you know, Jamie Dimon teaching the Fed a lesson, which is what he's trying to do, if that's what it was. Yeah. Right. The most.
In your view, do the travails at Deutsche Bank have a part of this?
I read they recently closed a division or sold a division or, you know, something, same sort of thing. It could be a Deutsche Bank, it could be WeWork, it could be the combination. But it seems to me there's something much more urgent, you know, than the J.P. Morgan story. But I'm just saying, it's like the dark state with Trump. This is the story that we're being fed. That's the conclusion of the markets is going to be. If there weren't such regulations, Jamie could have snuffed this thing in an instant. You know, so if that's it, maybe he likes seeing that it's 10%. You know, pointing. You know, if you just let us do our work. And I did read also today that banks are now convinced that they're going to lower the amount of reserves that they have to have in cash, et cetera, and start to allow some of the Treasury. So it could be literally Jamie just, you know, having a fit, and he let the thing go to 8.5% and said, see, you know, you just let us do our work. Yep.
When the repo market has the crisis, and then the Fed decide to print the 60 billion a month, and the Chinese media even says that it's the QE in a different jacket. So why at that time gold market is so calm, and Bitcoin also calm too, instead of a spike? Thank you.
Dan, can you help me with this one? I guess we're not there yet in terms of, I would like to think that gold always moves for I call them the right reasons, and these are the right reasons. I do think if you go back to May, gold took off 100% because of the Fed really putting in stone their reversal of posture. And that's why, you know, it became very apparent in late May that Jerome Powell was going to lead the Fed to 3 or so rate reductions. That's when that all kind of started. And that's why gold really took off. And burst right through that 2.5-year 1360 top. So I'm gonna take comfort in that gold almost all summer was doing things for the right reasons. However, one of the reasons we probably got to 1566 a little quicker than I think anybody thought was likely or perhaps healthy are all these other geopolitical things that have been going on with Brexit, and I can't even remember, but just Trump's daily, my big problem with Trump is as a relatively rational human being, I feel obligated to spend at least 20 to 30 minutes following what he did, just so I know what's happening. And I thought one day that hit me in the shower-ish, and I thought, he's supposed to be working for me. I got to spend 30 minutes a day just so I know what's, going on. And so I think gold got a little ahead of itself. And we all know that once gold stops going up, it has to go down. If that's you can tell I'm a big technician. I don't believe much in charts, but I have no problem in using them when they support my case. But I just think it's just blowing off a little steam. I do think repo. I think everybody wants to believe, human beings, and especially investors, when the S&P is 1% off its all-time high, we want to believe everything's okay, right? And the repo thing, it is the most highly capitalized financial institutions in the world, and it's 2.6 trillion, and it runs up these tiny little spreads. So nobody really cares or knows that much about it, and so I think everybody wants to believe, it was just an outbreak in an archaic plumbing market. But as I said earlier, it was a 44 standard deviation outbreak. I mean, and it was a lot, and it's getting worse. So I think by the holidays we'll have a better idea what's going on. But this whole thing, it's not QE. I think sometimes we're just focused on the wrong thing. Okay, so what? Another example is the negative rates, right? So when the yield curve inverted here, the first 3 or 4 times it happened, it was not the same. It doesn't have recession, And then the conclusion when everything inverted, it's not because of pending recession in the United States. It's because there's no positive yielding investment grade alternatives. And so all these people are buying treasuries because of all that negative yielding debt. And my response to that is, so what? That's worse, right? If the United States is the last option in investment grade sovereigns to get a positive return, that is so much worse for the the global financial system than whether GDP is going to take a hiccup in the U.S. That's virtually irrelevant. So a lot of I think we're becoming inured to saying, it's not this, it's not QE, and I try to shake people and say, okay, whatever you want to call it. I don't know how to go back on this, but it's just the scale of it, Okay, so it's not QE. What is it? You tell me. Do you see what I mean? With, all of that painstaking roll-off of, the balance sheet that was on autopilot, and we just reversed a fourth of it in 4 weeks, and we're saying it's not a big deal. It is a big deal. What's up?
One of the areas that we don't get data on, but which is very controlling, is the roughly 500 plus. One of the areas that we don't get data on, but is very controlling, is the roughly $500 trillion worth of derivative bets in the banking system. Roughly $300 trillion of that is U.S. banks, primarily interest rate and foreign exchange rate. But we don't get to see the trading stuff. Mm-hmm. But even a very tiny little blip in that market would cause enormous discontinuities. Will you comment on that? Do you follow that?
It's funny when in the first 10 years of being a gold enthusiast, I used to read the Daily Reckoning, and I'd have notes, and the lack of ounces at the COMEX, I spent a year or two, is there gold in Fort Knox? The derivative thing has been, such a ridiculous, and Deutsche Bank, by the way, the articles this week clearly talked about that. It's such a problem. I can't even really relate to it anymore. It's just, it's such a big number. So I don't think about it. I thought what you were going to say when you said 500 billion.
Trillion.
What?
Trillion.
Oh, trillion. Excuse me. Yep. Oh, right. The net value. That's notional, gross, or whatever. It's not as.
That's the notional value. However, they claim there's a lot of netting between.
Right.
That much at risk. However, that assumes nobody in the chain defaults.
Right. Well, once we get back to counterparty risk, it's game on for gold. I thought what you were talking about was the Treasury balances, which, by the way, have been going up since we passed the debt ceiling. A guy named Andy Leeser writes about this a lot. The Treasury keeps $300 billion at the Fed under normal circumstances. And then when we always hear about what they're doing, their piggy bank, that's what it is. When they're raiding the piggy bank, that's essentially easing because that money is going out into the financial system. When we got the debt ceiling passed for the last 8 weeks, the Treasury has been rebuilding its balances. When you ask why isn't gold doing better, it's almost like QT because they're taking that money out of the system, and so that's why that may be one of the things that's putting pressure on the gold price.
Plus, if you pay attention to the machinations, to the extent that you can get data at all, which we don't really get to see the trading slips ever, the machinations at the Bank for International Settlements, they're doing trading in gold all the time. They report it in their annual reports and their quarterlies, and all the stuff that they do is secret. They have sovereignty, not subject to subpoena.
There's no question that the BIS has quarters where they're, a couple hundred, like 150 billion will be, their gold derivative position will increase by 150 billion. And there's no question that that's lending gold out, to bears because nobody wants that much gold to put in their garage, right? So it's being borrowed to sell or borrow, and that happens twice a year too.
Actually, we have no idea. I'm saying so much of this is secret.
Yeah.
And the kind of stuff we're looking at, that you're looking at, the rest of us, we only get what's reported.
Yeah.
And very little. I mean, I don't think a tiny fraction of a percent actually gets reported. All the rest is secret. How could we know?
Yep. And
But we do know, like you say, that they would like to see the price of gold repressed. We do know that. They've spoken about it.
It could also just be I'm getting to the point where I try to stay away from as many self-impeaching topics as possible, just because there's so many hurdles and people, and stuff like this. What are you going to do? It's like we'll never know. It's just part of it. It can have an effect for short periods of time, and then you have periods. But what I'm actually excited about is I'm feeling deflation. I think there's a very deflationary feel in the air to me in the past several weeks. And I think the Fed notices it, which is why we're seeing stuff like this. And sometimes you get in a position where the Fed wants to see a little inflation. And I'm convinced that it's not like Bernanke in the bathtub with the phone, smash gold. It's more the system is built to reward behavior, JP Morgan bonuses, the whole system is built to reward and incent and bonus behavior that is the opposite of gold, right? So the whole system, and then there becomes these moments like now where, if gold went up a little bit and we felt a little inflation, I'm not sure the Fed wouldn't appreciate that at this point.
Well, that's exactly right. And in fact, every country, including our own, now has it as official policy. They tell you that they want to depreciate the purchasing power of the money. Their jargon is inflation targeting, all right? But on deflation, you have that exactly right, too. And it really speaks to deflation is that you have overcapacity everywhere in every industry, in steel, in autos, and all the commodities. Everything is overcapacity.
Right.
So how can you not have deflation?
And what you said is true. To me, it's more the debt, going back to my... You missed, Dan, if you were going to put the gold trade in one slide, I don't know which one you would pick, but I'm still here. This is just debt to GDP, and that's going to resolve itself at some point. There's just no way you can have 350% total credit on top of, a GDP, no matter how healthy. So it's, this is the deflationary force, and it's just everywhere. It's everywhere now. We just built it up, and it's 275, trillion in debt, globally. I mean, every single debt measure you can possibly think of since 2009 is ghastly worse today, ghastly worse, except for, a small little portion of financial credit, which went bust, and maybe a little consumer deleveraging, but everything else, is off the charts. And another one of my favorite statistics is household net worth. Is one of my new hobbies is, the Fed every quarter in the Z1 comes up with household net worth. And we've gone from 54 trillion to 110-ish on like a $5 trillion GDP gain, The ratio's 8 to 1, so I don't have those numbers memorized. But somehow magically, since 2009, for 10 years, we've been growing household net worth 9 times faster than output in the United States. That's a neat trick, right?
That's all based on BMI.
Oh, absolutely. It's all based on QE and, everybody, this is my last little peeve, and I'll let you guys have drinks, but everybody says, QE was going to cause inflation, and it didn't happen. I'm like, QE was designed to impart inflation on the 2 most important financial assets in the world, treasuries and MBS, and it's exactly what it did. It worked remarkably well in causing inflation, and then through credit spreads, and I'm not a bond guy either, everything else went with it. The inflation's right in front of you in the room. If you're looking at the price of hedonically adjusted hot dogs in Houston, you're looking in the wrong place, right? And by the way, if the price of hot dogs goes up, why would you buy gold? It has nothing to do with it. But the last thing I've learned is, just because I think CPI has nothing to do with gold, if everybody out there thinks CPI has to do with gold, we may have to have CPI go up, for gold to work. I don't know. Anyway, thanks a lot, guys. That was fun.